Welcome to Behind the Deal, where we'll be exploring unscripted, candid, first-hand experiences about the wild successes and cautionary tales of professional investors, founders, consultants, and advisors as they share their stories in deal making. Thank you for joining us for another episode of Behind the Deal. Today, I am joined by Kevin Woltjen, corporate M&A PE securities law partner with Nelson Mullins. Kevin, thank you for joining us today. Tell us a little bit about yourself. Tell us about the firm.
Thanks, James. I appreciate the opportunity to talk with you. Name is Kevin Woltjen, primarily a mergers and acquisitions lawyer, but also do corporate work, private equity, investment, securities law. I'm with a firm called Nelson Mullins. We have over 1,000 lawyers. We're a full service firm around the country. So when things come up, we can help with about anything. I do provide some outside general counsel services to companies who don't really need a full-time lawyer, and so they call me when they have legal needs that arise. I've been practicing since 1994 when I got a JD and an MBA, and I've been doing this ever since, so 31 years of practicing.
Excellent. And you and I have chat a few times over the months trying to work this out, so I'm really excited to have you here and talk about some of the stories you got. And with that, let's kick this off. Tell me a story.
Well, it's funny how wild successes sometimes start with the most humble beginnings. And one of my favorite client stories is a current client, although they've tried not to be a current client. So two guys came up with a great idea. They were in the software industry generally, and I'm not going to say because of confidentiality,
Sure.
because their market is real niche. But they identified the software that their employer was providing. They made recommendations on how to improve it to enhance the experience by the ultimate customer, who also is in the service business. And the client said, we're already so dominant as a market leader, we're comfortable. And so the two guys were the most senior employees who didn't have a non-compete agreement not to compete with their employer. So they said, hey, Kevin, would you help us get started? We need to raise some money by selling equity in the company. That's also called securities. That's what securities law is a lot of times. And so I helped them put together some materials. I'm about 15 years older than they are, so my gray hair helped with some experience on their behalf. I helped them dodge a couple investment opportunities, and they found a group of friends and family, and they raised a couple $1 million, and they started their company about 10 years ago. And it's just been a wild success. So a couple $1 million got you 50% of this company. I didn't invest. Who knows where it's going to go? Two young guys starting out on their own.
That was in the beginning?
Yes. Yeah.
Wow.
I'm sorry?
That was at the beginning?
That was at the beginning. And so the two founders, one guy was the tech guy, the other guy was the customer service sales guy. And the customer service sales guy says, hey, look, what we're providing is great, but I'm telling you, the clients want different amenities, different software attributes. And they said, we can do it better. And so they went off on their own, launched, they expected about 18 months to start selling. They beat that, got to market in about 12 months, and just went to their old customers and told them what they had and showed them what they had. And all of a sudden, they started getting clients left and right. And so that client-centric focus allowed them to build a better mousetrap, as they say, and the growth has been exponential. And in that field, they were in a tiny niche market of it, but guess what their client said? Hey, you're doing this. Can you help us with that? And so they're like, I guess so. Let's try and build it out.
I love that because I constantly, as a marketer, I constantly talk about how the riches are made in the niches, right? And going small first and then expanding from there. It's like solve one problem. You don't need to solve 10. You don't need to be all the things, all the people and try to hit the entire TAM, right? Your total addressable market. It's just solve one problem, be the master at it, and then expand from there. That's how business should work. So I love that component there.
It's been exciting for me hearing the new ideas that these guys are coming up with, and we're trying to protect them with intellectual property around their different ideas. And as they're going into new markets around the country. There's new legal requirements. It's a regulated industry. But it's been so exciting to watch the client grow. They got to a point where they said, we're worth a lot of money, well into 9 figures, but we don't have a lot of money, so we think we want to sell the company. So they got an investment banker involved, and we're talking about valuation. The problem is, James, they're growing like this. They're just hockey sticking it, and they're taking up more and more market share, and they know what the valuations in the industry are. And the banker said, oh, we'll sell you at this price. And they're like, yeah, but our growth expectations, projections, that's a really low price. And they said, well, yeah, but you can't sell on projections. And so they said, well, we really want, to get some money. We want to buy a plane, and I want them to have a plane, right? And so we found a bank. They were lined up because these guys are making so much money. And we did what's called a dividend recap. They borrowed money against their accounts receivable, and they took a big chunk of money and they paid it to their investors as a dividend. And then they've just paid that off. So that's one way. When a company is growing that fast, it's hard to identify what the fair market value is, because if they do grow so much, then it's going to be a screaming deal for the buyer and the sellers lose out. So this dividend recap thing is one tool that allowed these guys to put a bunch of money in their pocket. The company's paid off the debt, and they got their plane. So they're still growing.
Is that maybe a way to, or I guess a means of extracting money for themselves?
And their investors. So yeah, to be fair, they borrow the money and then they paid it out as a dividend pro rata to all of the investors. So the group that put in the $2 million, I think they've received at least, maybe not 100-fold, but I mean, it's been wildly successful, and they keep repeating that.
Yeah, so they've been paid out basically.
Correct. And but they still have that ownership.
They're still the investors are still in the deal.
Yes, sir.
Oh wow! So so they were able to pull money out of the business.
Yep.
For the investors, they have pulled it out for themselves as well in that situation?
Well, they owe as board members and founders, they owe fiduciary duties, and so it wouldn't have been very good corporate governance if they paid themselves and not their investors. So,
that makes sense.
And so their investors were friends and family, and so the investment terms weren't draconian, and so they might have been able to do it. But they're also good guys, and they want to repay their investors as a thanks for having faith and putting up a couple $1 million. I see enough deals where people put in a couple $1 million. It seems like a great idea, and it's hard to. I mean, there's a reason why that's a rainbow unicorn, because starting with a couple $1 million and being worth $1 billion, that doesn't happen very often. But these guys have done it, so it's a really exciting story for some entrepreneurial guys.
That's awesome. And so, how has that unfolded since then? Are they still continuing upward, or is that kind of like the most recent situation?
No, I was on the phone with them yesterday talking about another niche market that their clients want them to get into. And so I'm like, okay, in the technology software space, and my firm has a top team, technology, outsourced, privacy, data protection. And so those guys have been real helpful. My partners have been helpful in allowing, because you can only specialize in so much. Now, I'm not a data privacy guy. I'm not a technology. I do a lot of technology deals, but I have tech people who focus solely on technology, data privacy, and having those other experts to come in and provide documents and contracts that my client can give to their clients, and everyone can be happy with, and everyone can be protected.
I see.
It's easier said than done.
Yeah, that's excellent. And so that was sort of their hedge against getting out too early, right?
Correct. And so they're still thinking, and the investment banker who they had an exclusivity for, they signed the agreement, let's say January 1, 2020, and after 12 months, they're no longer bound to that banker, but you better believe that banker wants them to sell. And they're interested in selling at the right time. It's just, as as fast as they're continuing to grow, it just doesn't make sense to sell. It's a great story.
Is there I guess, a situation where they would execute that approach again, like to repeat it, or would it not really make sense?
With the dividend recap thing? Yeah, no, they've done that a handful of times now.
Okay. Okay. Oh, that's great.
Once they pay down, like the first time I think they got like $30 million and they borrowed $30 million dividend. They paid it out as a dividend, pro rata to the owners of the company, and then they paid it down. And the end of the second year after they paid that off, they did it again.
Okay.
They're taking a couple different bites of the apple, so to speak.
Yeah, so it's repeatable. So that's great. That's an awesome strategy there. So
Yeah.
for those that are listening, if you're worried about scaling and missing out on potential upside, that's a method that you could use.
Yep.
So you've got that story, which is excellent. Yep. You have another one that we were kind of talking about before, right?
Yeah, and it's the story about the seller who, my clients are usually successful enough to pay my fees. So, and I usually talk to the C-suite, the CEO, CFO, and it's funny how these people are making a lot of money, more money than they ever thought, and they presume to know. And if you, as outside lawyer, if I tell my clients they're wrong, I might lose the client. It's a little bit of a battle. You can lead a horse to water, but you can't make it drink. It's a classic scenario of that. Client, similar guys founded a company in the service business, oil field services, and I helped them get started, but I didn't know a ton of what they did before. I just knew they were in the oil field services business. They grow the company out, it's doing great, and they say, okay, we're going to go to market. We signed up a banker to help us, identify potential sellers. And I said, would you let me engage in due diligence on you as if I represented the buyer so we can avoid any aha, oh no moments. Like, well, no, it's all good. We've got it all covered. The banker's got a data room set up where all of our materials are. And so I said, okay. So here we go. We're in the process. We've got a buyer. We start looking into things, and they start asking me questions. Meanwhile, the buyer's distracted because it's deer season. He's off hunting. So he leaves me for a phone call with the buyer's counsel, and they're asking about, where did you guys get the technology for this? And I'm like, well, they came up with it on their own. I don't know.
Wait, so the seller was asking you questions
about the buyer. I'm sorry, maybe I misspoke. I represent the seller. The buyer is saying, hey, where did you guys come up with this technology?
Okay. So the buyer started questioning you about the business in detail.
Correct. Oh, wow. Because my client's out deer hunting, which is great for him, except I don't know all these foundational background stories.
Yeah.
And so we start looking at it. We explain it to them. They look at it again. They ask me, hey, what about this bankruptcy? I'm like, what bankruptcy? Well, the company where they were at before went bankrupt. I'm like, I don't know anything about it. I wasn't involved. And
is that like the company that was bankrupt was a portfolio company of the seller?
They used to work at the bankrupt company. And the question would be, did the technology that they used to start the company, was it owned by the company that went bankrupt?
The prior company. That could be a potential landmine.
Correct, because you have to own title to the assets to sell them. And so trying to get buyers comfortable with, yes, we own the technology, they start digging into it more. Guess what we realize? When we dug into it, there were 3 other people who were involved in that same technology.
Oh, man. And this is like an IP. Is that right? Is it IP?
Property, that's right.
Oh, goodness gracious.
Right. Yeah, so I'm like, I don't have the answer. We start looking into it a little bit more. Guess what? The deal died. And after that, we went back, we talked to the other people, and we settled with them, got a release of all technology, and the company, a couple of years later, was able to sell.
That's the other 3 owners of the IP?
Correct. Alleged owners.
Right. I know. The oil and gas is that's an interesting place to do business. So you're able to get that release, and so that your original seller was able to just have that wholly owned.
Yep.
And then were you the original deal died, but you said that they were able to sell the business finally?
Yes. So
Was it to the same buyer?
oh no, 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 no. There was a little bit of bad blood on that one. You know what I mean? And that happens sometimes. And
Yeah.
you know, there are times when deals shouldn't get closed because when people buy or sell from a person they don't like, that's a whole other issue. That could lead to landmines and post closing arguments and lawsuits and legal fees and yucky. So it's
Yeah.
important to identify who you're doing a deal with and are you like-minded. If not, that I've got other stories about that, as you can imagine.
I think it's probably, one of the takeaways for me too is just going through the process the right way. I mean, I think the biggest red flag, the first part of the story, was your client, the seller, was completely like out of touch. They were on a hunting trip.
Yep.
For how long were they on the trip for?
3.5 weeks.
Oh,
And so their availability was pretty intermittent, and then they were out in the middle of nowhere, so the connectivity was bad, and the
wow.
buyers just got fed up. They got fed up, and we had other issues, and like, you know what, pens down, the deal's off, and that was a bummer. I like it when deals close.
Yeah, of course. How big was that deal exactly? Or like,
$105 million.
$105 million, and you're on a hunting trip for 3 weeks.
Priorities, man.
Yeah, I guess so. See, for me, I feel like, for those that are watching, it's like, if you're going to sell your business, do it the right way. Be present and take it seriously. I mean, $5 million, I would have been all over that.
Yeah.
What
So, anyway,
what were some of the takeaways for you in that whole experience? I mean,
so I often talk with clients as I prefer to talk to if someone's going to sell, I prefer to talk to them sooner than later so that we can identify if we're personally compatible. And I really stress, let me engage in diligence on you as if I'm buying the company or if my client's buying the company so that we could identify if there are any landmines out there that we need to address. I talk and present sometimes on preparing to sell your business. And a lot of times people, especially bankers, they look for clients who aren't for sale. Partly, I think, because they're not prepared to sell. And if you start at a purchase price of $100, let's just say, and you identify risks in intellectual property, well, we're going to lower the price because of that. You've got you don't have a diversified client base. We're going to lower the price for that. And so my objective is to get the best deal possible for my client. Obviously, it's very one-on-one. But when someone's selling a company, the highest price is going to be achieved when they're the most prepared and they have very clear answers to every question a potential buyer can ask. That provides comfort and confidence that they're getting a tight ship, as they said.
I think this would have been a perfect opportunity to have a due diligence questionnaire in place. I feel like not a lot of folks know what that is, but when you're dealing with sophisticated investors or buyers, like at that $100 million level, that's pretty sophisticated. That's a real deal. Having a DDQ, due diligence questionnaire, would have saved you right there. You could have turned that over to them if the seller had already been prepared, and that way you don't have to answer any questions. And just like to your point about kind of doing diligence on them as if you were the buyer, you could have gone through all of those questions that could have come up, even about like the bankruptcy is a perfect example, and you would have, that would have been easily swatted away, right?
Well, and what's funny? So I've had some interesting conversations with potential sellers. Like, well, Kevin, I can get a questionnaire off the internet. I'm like, you don't pay M&A lawyers to give you a due diligence questionnaire. You pay for us to go through the answers and to identify, wait a minute, do you have environmental issues? Do you have employee issues? Can your employees leave? Who's the secret sauce? And where does that come from? Does that person have a non-competition agreement? you should get that. So preparing to sell your business, and ignorance is bliss. If a client is confident, like the intellectual property topic I talked about, client was confident that it was all tight. Turns out it wasn't, and that's no. Clients are great at what they do, but that people and I don't want people take lawyers for granted. Oh, it's easy. Well, identifying nuances in diligence responses is the secret sauce that a lawyer, like me with 31 years, I like to say I bring to the table, because I've seen so many situations. Oh, wait a minute, I'm not sure I like that. Let's dig in a little bit more and get comfort, so that when a buyer asks that exact same question, whammo, here's clear answer, unequivocal. That's the benefit of it.
I'd say the takeaway there for those watching is trust your service providers, trust your advisors, and be completely upfront with them from the beginning. And that's how you avoid landmines. Is that safe?
That will save you a little bit of diligence early, saves a lot of trouble in deals that get killed.
It seems like all of the deals I've heard about where they blow up like that, it's always ultimately the same thing. It's like they weren't prepared, and in not being prepared, they didn't communicate with their advisors. That's the takeaway. That's the insight right there. Communicate with your advisor.
Let them do their job.
Absolutely. I feel the same as a marketer. It's the same exact thing. It's like if those of us that are consultants, basically, you hire them for a reason. You should probably listen.
And again, the objective is to get the client to understand that. You don't want to, it's not good business telling the client they're wrong. But if the client realizes there's a weakness, then let us solve that and make that an area of strength.
Absolutely. I agree wholeheartedly. Kevin, these are great insights. The two stories are great. You had a good story and then a not so good story that turned around to a good story. So I love it. That's excellent. For those of you watching, I hope this was entertaining for you as much as it was for me, as well as insightful. For more episodes of Behind the Deal, find them on my YouTube channel. Thank you for watching. Thank you, Kevin.
Thank you, James. Have a good one.